Ours is a completely data-driven process by which we try to deconstruct currencies and find out if there are misalignments that we can potentially exploit in various strategies. It's done in a very rigorous manner. So everything that is constructed has been statistically checked and is driven by over 20 years of data that's gone into a model to create what we view as potential fair values or potential misalignments for each of the individual currency. And so this model must be driven by some understanding of basic features of currency markets. So currency fair value framework is to bring about all these features that drive currencies together into a model and to try to use those features to generate our estimates of where currency equilibrium should be. So there are three very powerful concepts in economics and finance that we use in our DEAR model. The first is purchasing power parity. The second is productivity differential, or the so-called Balassa-Samuelson effect, for those of you who are quite knowledgeable about economics. And the third is about trade competitiveness stemming from terms of trade. So there are a couple of issues that we'll discuss also further in the presentation, which is whether misalignments actually do correct, right? And if they correct, how long would we expect these misalignments to take to narrow? And that's where we bring in considerations with regards to half-life. Half-life is a concept that economists have borrowed from physicists, which describe how quickly or the time taken for a certain misalignment to narrow by half. So we'll talk through about the half-life estimates that we've done in the context of our DEAR misalignments and valuations. Next slide. So first, the most simple or most fundamental idea behind the DEAR is purchasing power parity. So I think most of you have heard of the Big Mac Index, where you compare the prices of Big Mac in different countries based on the exchange rates, and Big Mac that is more expensive in certain country means that the exchange rate for that country is perhaps a bit too expensive, is too high relative to its fair value. So this idea of purchasing power parity can be generalized to basically a basket of goods, right? So consider two economies. In this case, I've used the example of the US and Singapore. It's a very classic 101 exposition. So if, for instance, overnight we find that prices of goods in Singapore basically doubled for whatever reason, right? It could be, shortage of fresh chicken. It could be a shortage of whatever commodities. And what does that mean for the exchange rate under purchasing power parity? So that basically means that for trade to remain competitive, for basically for net export situation to be stabilized, if the basket of goods that we produce in Singapore has become twice as expensive as that of the US, then the exchange rate will need to fall by half. So dollar Sing will probably have to double from current level. So from a very high level perspective, we can generalize what I've described for a single pair of currency, which is the US dollar against the Sing dollar, to actually any pair of currencies. And in fact, we can generalize it to basically a combination of exchange rates, which can construe the effective exchange rate of any currency. So effective exchange rate effectively is just a trade-weighted exchange rate. It gives a more general idea of currency values than looking at just a specific currency pair. So under purchasing power parity, we will expect that the real effective exchange rate will be constant or will be relatively stable. How do we derive the real effective exchange rate? So we are just shifting terms over here. So if you look at the equality in the first line, we're just moving the price indices from right-hand side to the left-hand side to create the real exchange rate. So maybe talking about it in very abstract terms is hard to understand. So we can visualize the power of inflation differentials in driving FX changes by looking at how currencies perform against the dollar over a 10-year horizon versus their 10-year annualized inflation. So if you look at this chart over here, what you see is that points are clustered along a 45-degree line. So this 45-degree line is the best fit line. It shows that the higher country inflation is over a long period of time, the more depreciation is likely to suffer over that 10-year horizon. So in the short run, sure, over one year horizon, maybe it's very hard to say that inflation drives currencies, but over the very, very long run, if inflation becomes too disconnected from what the rest of the world is experiencing, then naturally there will be depreciation pressures that come through on the exchange rate front. So I'll discuss the other two factors that we incorporate in our DIA. The second factor that we incorporate is actually productivity. So it's a well-known empirical observation that countries that are more advanced or countries with higher productivity tend to also have higher exchange rates compared to countries that are developing or emerging market economies where productivity is lower. And again, we can visualize this quite easily. So if you use a very crude measure of productivity, which is GDP per capita, and you look at the deviations of market exchange rates from their PPP implied exchange rates, you can see that countries with higher productivity will see smaller deviations from their PPP exchange rate levels, and countries with very low productivity, their exchange rates are very much lower compared to a PPP level. So this is a famous finding by Balassa and Samuelson. So we tend to call them the Balassa-Samuelson effect, which is predicated on productivity differentials across countries. And finally, on the third factor that drives currencies, it is actually the terms of trade. So terms of trade sounds very complicated, but it's not at all. It's just the ratio of export prices versus import prices. So the prices for your exports, your commodities, export goods versus the prices of your import commodities and import goods. So typically when a country has a positive terms of trade boom, that means that demand for the commodities they export have risen very sharply relative to supply. Prices of this commodity has risen very significantly. What that tends to imply is that there's a bit of a boom to the economy. So in this case, I've shown the Australia terms of trade over the last 20 years. And then you can see very clearly that the Aussie real effective exchange rate tracks the terms of trade pretty well, at least from the period 2000 to about 2015 or so. So unsurprisingly, economists have also coined a term for such a phenomenon. It's called the Dutch disease, because if an economy is benefiting from higher export prices and therefore suffers very high exchange rate appreciation, other sectors in the economy is going to be facing export headwinds. They're going to be less competitive compared to their trading partners. They're going to see smaller market share and smaller production going forward, and that could potentially be a contractionary effect on those other sectors that are not exposed to the commodity boom. So it's quite obvious that over the long arc of history, terms of trade has been and will remain a very key driver of currencies. So let's talk about how the DIA is constructed. So you can think about it as really looking at the nominal effective exchange rate plus. So I'm just using an analogy from computer science, right? We have the C programming language, and the augmented version of C programming language is C++. So in this case here, you can view it as a near plus. So what are the plus? So the plus is higher, we incorporate inflation differentials, we incorporate productivity differentials, and we also incorporate terms of trade differentials, and we put them all into a massive multi-country econometric model to derive estimates across a very large number of currencies in trading in global markets. So maybe just as an example of how the DIA valuations actually look like, I have given an example over here of the sterling DIA valuations versus the sterling dollar cross. So historically, when analysts look at currencies, they always focus on the cross versus the dollar. But that's not necessarily a very good way of looking at currencies, because the way currencies as quoted against a cross, there's no natural anchor for them. So if you look at this sterling dollar picture, you see it moving from 140 in early 2000 to and then coming back down. And then, if there's reversion, you will expect sterling to probably trade around 160 to 180. But in this instance, a lot of things have happened to the UK economy over this period of time. So if you look at a very sharp drop in the sterling exchange rates in 2016, what was the outcome of that? It was actually because of Brexit. And Brexit naturally implies the economic potential of the UK economy is perhaps less rosy than before. This is a very sharp shift. And if you don't incorporate things such as productivity differentials, where we expect UK productivity to be somewhat hit from Brexit, then there's no way you can find an anchor in just looking at nominal exchange rates. So on the other hand, if you look at the DIA valuations, it's very much clearer that there's this center line by which valuations will tend to move towards over time. So that's what we call narrowing of misalignments. So I'm just going to quickly show you some of the visualizations work that we've done for currencies using our DIA valuations. So just give me a second to start my browser. And sorry, there's a bit of a technical issue over here. Okay, so my browser is now successfully opened. So this is a visualization suite that we have developed to help investors as well as clients get a better sense of our DIA valuation. So on the left-hand side, we rank the 8 major G10 currencies that we follow on the basis of the DIA valuation. So the yen, as it stands, is the cheapest currency, and dollar is the most expensive. And we also show on the right-hand side how the DIA valuations have been changing over time and where the current valuation is right now. So for instance, if you look at the yen, you can see quite clearly that the yen has been very cheap since 2012 when ex-PM Abe took over and embarked on Abenomics with attendant monetary easing, strong monetary easing measures coming through. And that's led to a suppression in the yen and led to a much cheaper yen than what we have seen otherwise. And you could see how valuations change over time. So this gives a very good visual of how different currencies have been performing. So on the other hand, if you look at the US dollar, you could see that there was a brief period of time from 2007 to 2015 when it was very undervalued, and now it has rebounded and moved back into its overvalued territory. So there are also very nifty controls that we built in. So you could look at things not just from the valuations perspective, but also from the quoted cross perspective. So you can look at, for instance, the Kiwi dollar quote, or you can look at it from a DIA valuations point of view. You get a good sense of how the link is between valuation and prices. So we hope to eventually make this public for all. So I'm just giving a very quick preview of our visualization pipeline and accompanying suite of macro analytics that we hope to roll out this year. Okay, so moving back to our presentation, let me go back to the slide deck. So as I mentioned, the DIA model is basically a global currency model. We have about 30 global currencies that are included in this model. So I've ranked all the 30 currencies from the most undervalued to the most overvalued in this very simple chart over here. Actually, this was an idea suggested from a client. So if you have so if you look at the black line over here, if the black line is closer towards the center of the circle, that means that currency is very undervalued. And if the black line is very far away from the center of the circle, that means that currency is overvalued. So you can see at a glance how 30 currencies are ranked based on the current DIA valuations that we have. And the Canadian dollar is actually about near the dividing line. So currencies to the right are probably undervalued, and currencies to the left are overvalued based on the DIA methodology. And just for the sake of completeness, we also focus on just G10 FX in our presentation. You could see the rankings of G10 FX of 8 G10 currencies right here. Most currencies are somewhat overvalued, but we have very clear indications that the sterling and the yen, they are relatively more undervalued compared to what the factors that we have in our deal model would indicate. So all this is well and good, right? So we have a model and we have valuations that rise out of this model. But if you think harder about it, it's really, a bit of a in-sample fitting. So valuations arising from in-sample fitting, how confident are we that this is actually useful if we try to trade our sample, right? If we try to put on trades or strategies our sample, will this in-sample valuations be actually helpful to our trading? And we know for sure that DEAR is very much superior to a real in-sample because we know two things. The first thing is productivity in terms of trade differentials are highly significant in our DEAR model. And the second thing is because, okay, this is a bit more technical, there is some statistical evidence that the DEAR valuations are stationary, so they tend to mean revert, but we don't really find that for the real. So from that point of view, using DEAR in sample is definitely going to be more superior outcome compared to the real. But let's talk about our sample model performance because this is what really informs our strategy, right? So we want to know if the DEAR valuations actually help predict currencies returns on an ex-ante basis, not just on an ex-post basis. And this is where we talk a little bit about how we come up with a model to try to see if the valuations actually have some useful information, some useful signal for ex-ante FX returns. It's a very classic model from Pharma and Macbeth. It's actually used by them to show the effectiveness of CAPM beta, but we could use it for any kind of factors. And in this case, we're using the DEAR valuation as a factor. So the DEAR valuation gives some statistically significant correlation with currency returns, then we know for sure that it's informative and could help in terms of predicting FX returns. And generally speaking, yes, the outcome is that the higher our valuation, the more negative returns will be, and the lower or more negative our valuations, the more positive our returns will be. So the slope of this regression model or the beta is negative as expected. So it gives us a lot of confidence that we can depend on this DEAR valuations even our sample, right? So this page effectively show how significant the estimates are. So on the right-hand side is all these the estimates for DEAR misalignments from a 1 month to 12-month holding period basis. Across all 12-month holding period, the DEAR's misalignments are significant, but on the other hand, the real have no such predictive value, unfortunately. So using the real on its own is very, very dangerous in terms of a currency trading strategy. So let's talk a bit more about how to construct a DEAR strategy, how to construct a currency strategy. So right now we have a bunch of valuations. How do we turn these valuations into something that are actionable, right? That people can actually use for investing. So this part of the presentation will be talking about details surrounding portfolio construction. So let's think of on a high level basis, what are the features that our strategy should have, right? So when we're conceptualizing our DEAR strategy, we thought there are 3 very important features that are paramount for such strategy to be successful over the long term. So the first is obviously returns, right? Must deliver positive absolute returns. And these returns are, of course, driven by the narrowing of misalignments that we have identified earlier, of course, subject to carry considerations as well, because currencies, they do have carry differentials that we must account for. The second feature that we talked about is resilience. So as always, markets, they are always changing. There will be unexpected moves in markets. For instance, this year we already have a war breaking out in Europe, completely, beyond the expectations of most investors in the market. So resilience is what we define as kind of an attribute of a strategy to withstand unexpected events, unexpected stresses. It can be achieved by diversification, but also it can be achieved by being more mindful of various risks that could arise in markets. I'll discuss a little bit about that later on. And finally, is rational. want our strategy to be rational. It's various strategies are such that, if there's stop loss, the strategy will exit, and then if a strategy is making money, then there will be some take profit level. So, but if you think about it, a strategy based on stop loss and take profits, they're not completely rational, isn't it? So the way we have designed the DBS strategy is that it only changes positions when the data changes. It's going to be completely data driven, not necessarily driven by the P&L of historical returns, but rather by the fact that if the data has shifted very certainly in this direction, then we need to, either enter or exit this position. So I think that's one of the features of the DBS strategy is very consistent over time because of this hyper rationality, and also because it's completely data driven. So there's very little of the human biases of fallibility of humans analysis in terms of driving a strategy. So the strategy is completely data driven and try to maximize these three attributes over time. So let's talk a little bit about returns and resilience. So the expected returns, as I mentioned, they are primarily informed by our DBS valuations, but also at the same time, this is the real world. If you do a currency trade, you have to take into account the cost of carry. So there's definitely some amount of adjustment that we have done to try to modify the valuations for the cost of carry. So if a currency is overvalued but have a negative cost of carry, then it's pretty obvious it's a straightforward short, right? But in most cases, what we tend to find is that overvalued currencies tend to have high cost of carry. They tend to be expensive to short. So how do you balance that? Two features in a currency strategy. That's where we've done a lot of groundwork to try to find the most optimal combination, which will work over the long horizon. Resilience. So the DBS strategy is not focused on any single currency pair. It's not, say, focused on just one pair of currencies, say the dollar or the yen. It's focused across a basket of currencies. So that means that if there's any volatility, unexpected news, or if there's any kind of unexpected developments, the strategy itself is not going to be too badly affected because we have running a series of diversified positions within this basket. So some adverse events in one part of the basket may be offset by some positive returns from the other part of the basket. So on the whole, it creates a more resilient investment strategy for investors. So that was a very, very key focus in terms of our strategy conception. And also importantly, the currencies that we have selected are primarily aimed to minimize sovereign risk and to minimize geopolitical risk. So we have seen this year several countries getting involved into credit crisis. Sri Lanka has to default on its dollar debt. Emerging markets in general tend to have a bit more propensity to get in trouble in terms of the sovereign thing. So that's one of the reasons why the DBS strategy in its current form is only focused on advanced economies currencies. And also geopolitical risks is always lingering, but I think starting from this, I think it will be a very big factor in terms of how investors look at markets. So within our basket, we have planned for this. We have thought a lot about issues such as this, perhaps related to imposition of capital controls, related to potential sovereign credit risks that could interfere and disrupt our DBS strategy. So from that point of view, we only select the most liquid and most freely traded currencies of very high of economies with very high political stability. So if you look at the map over here, these are countries that will be mostly insulated, I guess, from geopolitical risks, given that they are either US defense treaty partners or they are very strong on their own from a military point of view. They have very strong institutions that would safeguard economic stability. So only countries that can meet such high criteria has been included. And our DBS strategy actually just recommends positions across this portfolio of currencies, which we tend to imagine will be the reserve currencies of institutions such as central banks, as well as financial institutions. So in a way, this helps investors who may not have the skill or the expertise of large institutions to actually have a sensible way of approaching currency markets, right? So just following the DBS strategy can potentially bring returns to investors looking very closely at what's happening in currencies. Okay, sorry for the technical issue. So let's talk about, so from the high-level overview, let's go into the granular detail of how we actually develop this DBS strategy. So we want to be as robust as possible to data noise. So data is not perfect, right? So from that point of view, it's sensible to try to ensure that even if data is noisy, our strategy will still be able to hold its own. And also on top of the fact that what we observe in the valuations themselves is that they show very unstable correlations over time. So correlations that were high in the past could suddenly become negative or even worse, become uncorrelated. So what that means is that we want a strategy that can perhaps deal with all these various facets of markets, noise in the data, correlation that's unstable. And really, what's the best way to do it is, one of the best ways to do it is to let the data speak for itself, right? So we create a decision rule where we want to, short some number of most overvalued currencies and long some number of most undervalued currencies for, say, a period of time. And this period of time, how many currencies to long and short, this will be entirely informed by the data. So we look at, we run simulations, 64 different simulations covering about 6,000 monthly returns over the last 10 years to find out which combination or which strategy combination will offer the highest Sharpe ratio, right? So you don't want just the highest return, you want the highest return per unit of standard deviation or per unit uncertainty. So one way of describing this is in terms of, you don't just go long the most undervalued and short the most overvalued, because, if it works out great, you have very good high return. But if it doesn't, then you also have very high downside risk. So by diversifying across a number of pairs, currency pairs, then you actually can bring about a higher Sharpe ratio and have a better risk return profile for yourself. So our analysis is shown via this Sharpe ratio surface on the right side. You can see that Sharpe ratios peak somewhere around the 12-month holding period with just 3 longs and 3 shorts. And of course, the strategy has some smart holding period design inside where, we do not exit a strategy just because, we do not exit a trade just because the currency has become undervalued. So there's some consideration of the fact that there's persistence in the movement of currency. So the holding period could change only if it moves from overvalued to very undervalued. So it's not just overvalued to modest valuation, but overvalued to very sharp undervaluation. Then we consider an exit. So in a nutshell, there is some design to try to maximize returns from the fact that the currency moves tend to be persistent across a short period of time. So the process is quite simple. Step 1, generate some de-evaluations within our sample set of investable currencies, and 2, create those deal recommendations, as we mentioned, 3 longs and 3 shorts, and bring it into the strategy. So in this case, for instance, as an example, because the yen, the sterling, and the CAD or Canadian dollar are ranked as the 3 most undervalued, and the Kiwi, the US dollar, and the Swiss franc ranked as the 3 most overvalued. This will be the short and long positions that were put on for this strategy. So here is a chart of how such a hypothetical strategy will have performed over the last 10 years. So this backtesting is actually not done by me, it's done by trading and execution side. So what we can see is that even through very tumultuous market events, DBS strategy has managed to hold up quite well. We have gone through European debt crisis, table tantrum, 2014, a very sharp oil price correction and sudden abandonment of the Swiss franc cap against the euro as well as Brexit. And throughout these market events, generally, DBS strategy has performed quite well because like I mentioned, it's really focused on a long-term valuation, so such short-term moves should not impact it too much. And two, and B, the fact is that there's very strong diversification in the basket. So any individual event in a specific currency tend not to have too large an impact on the basket itself. And we also find that based on correlation and analysis, that there's very small correlations with equities and almost no correlation with investment grade credit.
Yeah, so let me just stop you here.
Okay.
We got a question from a timer. So I think a lot of what you've said is that you're looking for common factors that suit a certain type of country. Therefore, it is easier to execute this kind of strategy, and they are largely within the DM space. Do you have any considerations on extending slightly beyond the DM space? Right? Are there some EM that would fit closer? Right? Is it possible to widen the suite?
So definitely, from the point of view, when we first run our DEAR models, we look at the effectiveness of the valuations or the stationarity of the valuations for both advanced economies and EMs. And for the case of EMs, they actually do work quite well. So if you are an investor who is willing to embrace potential geopolitical risks, who is willing to embrace potential capital control, then the DEAR strategy and the DEAR valuations actually can be still very informative in terms of generating a strategy. So that's why I wouldn't say there's no possibility of us expanding DEAR strategy to a larger set of currencies. But for now, I think the focus is really, we want to build a portfolio of high quality reserve currencies where we understand things very well. We don't necessarily want to have a lot of turbulence, so to speak, to come through, as we've seen in the case of Russia, where the ruble came under heavy sanctions pressure. And so these are the kind of issues that you don't tend to confront if you look at just advanced economies currencies, but you do have to pay attention to and perhaps even demand some degree of human intervention into your strategy to be able to succeed in this kind of scenario, so to speak.
Okay, thanks very much.
Right. So now we move to the final part of our presentation where we'll just have a look at the performance, the analysis of historical returns, and also give some outlook on how we think the currencies in the DEAR strategy will perform going forward. So first thing first, a chart of how DEAR strategy has performed since inception back in August 2021. So what we've observed is two things, right? So in terms of returns, it has been relatively more stable and less volatile compared to the traditional asset classes, namely US equities as well as global bonds. So and on a relative return basis, the DEAR strategy has also outperformed the S&P 500 as well as the Bloomberg Global Aggregate Bond Index. So on a net basis, I would say the returns profile and the volatility profile has been relatively good, demonstrating the effectiveness of this diversified approach towards constructing a portfolio. And the second thing to observe is that the correlations of returns for the DEAR strategy is actually very, very low compared to the US equities and as well as developed market bonds. A more scientific way of looking at this, think about it in terms of cap and beta, right? So if beta of an asset is high, then the expected return is expected to be high, or the required return of assets is expected to be high. So beta of DEAR strategy is very close to zero. That demonstrates that it has almost very little systematic correlation with the S&P 500. So we think the strategy will give very useful diversification for investors who have invested in traditional assets such as equities and bonds, and they're looking for ways to diversify risk from in these asset markets. And the diversification offered by DBS is also very rare for highly liquid assets. So what I can say for sure is that DBS strategy, because they are investing in currencies, is very easy to enter and exit. It's not the same for private equity. It's not the same for real estate, where the transaction cost can be very high, and it could also be very illiquid and difficult to exit at a point in time when you need to raise liquidity. Because it has done better than equities and bonds, really it will probably have outperformed any combination of portfolios that invest in these two traditional assets. For May 2022, I'll just summarize our recommendations, which is to continue to stay short in dollar, Swiss franc, and euro, and to be long in the Japanese yen, in sterling, and the Canadian dollar. Right, so let's look at the past return for the most recent 3 months from February to May. Given the recommendations that we have made, what we've seen is that the returns have been very, very widely dispersed, right? So for sure, our shorts have done very well. Our shorts in euro and Swiss franc notched gains of 6 to 8.5%. But on the other hand, this is balanced by, I would say, longs in our CAD, sterling, and yen, which underperform. And the reason for this is largely because dollar strength was a very dominant driver in the markets. So that has led to this dispersion of returns across long and shorts. And the overall return for the DBS strategy is minus 2.6%. The main reason is because the yen has weighed heavily on our strategy return. So the reason why the yen is so weak is because of policy divergence between BOJ and other central banks. And if you look at the distribution of dollar yen 3-month returns, what we have seen in the last 3 months is actually one of the worst outturns across the last 20 years, right? So it's very much unexpected in terms of the returns profile, which led to the underperformance in the DBS. So excluding the yen, actually the DBS basket will have notched a positive return. But the good news is that our well-diversified and a very well-sized positions ensure that even though we were wrong on the yen, it does not pose risk of an irrecoverable loss in the strategy. We lost 2.6%. Is entirely possible for the strategy to be able to recoup and potentially to recoup such a loss over the medium term, given the fact that fundamentals don't necessarily change, and the fact is that the yen remains very undervalued as of this point in time, and that's going to be a positive driver for returns going forward. So the very good thing is that because of the design of the strategy and the construction of positions, actually, in some sense, risk from unexpected shifts, they are proactively or rather automatically managed, right? So if there's any event that happens across a currency cross, it does not necessarily imply that strategy will face very severe headwinds, because other parts of the strategy can potentially compensate. So in this case, even though the yen was a big underperformer, the other parts of the strategy with positive returns have actually helped to offset a little bit. And more importantly, I would say that even though the DBS strategy has launched a negative returns, it has actually outperformed in an environment with very negative market headwinds. It has done better than US equities. It's done better than 10-year US treasuries. It's done better than global investment grade and high yield credit indices. As you can see, the table on the right, most traditional assets lost between 6% to 10% over this period of time. But generally speaking, our strategies should not be too correlated with how risk markets are doing. It's more or less dependent on market conditions. So if undervalued currencies become more undervalued, that means our strategy will have to be patient in terms of the eventual reversion of fair value in terms of the eventual returns that we can get in being invested in this strategy. Whereas in a scenario where there's very significant changes in the FX market structure, where we see valuations, where overvalued currencies start to move more decisively or more sharply towards its fair value, then we could see a pickup in returns coming through as we expect. And let's move on to talk about how returns has been since our last round of recommendations. So our last round of recommendations effectively is the same as the previous round. So we are still short the dollar, the euro, and the Swiss franc, and we're still long sterling, the CAD, and the yen. And over the last month or so, what we have observed is that things have moved more in favor of the strategy. That's partly because US Treasury yields have softened a little bit. There are some hopes that inflation potentially have peaked in the US. So we see a bit of a softening in the dollar, and that's probably helping the deal return on an aggregate basis. The interim return for the basket is about positive 0.5%. And let's move to talk a little bit about the individual constituents. So one of the reasons why the sterling was a bit of underperformer in the last round was because the Bank of England has become a lot more cautious in terms of recessionary risk. So they have stated that because of higher energy prices as well as tax increases, what that means is that the UK consumer could potentially be a bit more high-strung, and that could lead to a higher recession risk. But that narrative has changed quite a bit since the last BOE meeting. Part of the reason is to look at the most recent UK unemployment data. Actually, employment jobs created really exceeded market expectations. Not only that, the unemployment rate continued to ease to another record low, and at the same time, this is accompanied by strong wage gains, right? So from the labor market point of view, I think the concerns of recession are perhaps a bit not too they're not showing up the labor market effectively, right? So I think the governor may be right in the sense that that chance of a negative growth is higher, but consider the fact that potential growth across most advanced economies have come off quite a lot over the last 10 years or so. So it's far easier for an economy to enter into a bit of a negative growth patch, but without necessarily implying the labor market is going to soften a lot. So I think that's the kind of scenario which we have over here, where growth, because of potential growth is so much lower than in the past, we could potentially see a recession, but the impact on labor market may not be necessarily be as strong. That could also mean that policy tightening would still be needed in the case of BOE. So certainly markets have completely reversed the sell-off of sterling. It has completely recouped all the losses since the May BOE meeting. So for the CAD, I think it's pretty much a straightforward story. Crude oil prices have continued to rise. Also, at the same time, the central bank has continued to guide for further rate hikes to try to combat inflation. Governor Matt Clem has guided for another 50 basis rate hike tomorrow, and will likely be following or keeping pace with the Fed in terms of policy normalization to try to contain inflation. And let's also talk about Japanese yen, right? Because this is one of the big underperformer in our deal strategy. So some analysis that we have done on deal valuations, we found that the undervaluation tends to lead to a boost in export volumes for a country, as well as the compression in import volumes. So inevitably, what that means is that the very deep undervaluation of the yen will be a very powerful lift for Japan's real export growth over time. So from the current account perspective, we think that would give some support to the yen. That might even cause the yen to strengthen a little bit if the recovery pans out more strongly. Furthermore, Japan has announced a reopening to tourists. As with the yen as cheap as it is now, I think there'll be plenty of tourists looking to book their trips into Japan. That could spur new current account inflows for Japan that were not present for the better part of due to the pandemic in the last 1 or 2 years. And on the short side, ECB and the SMB have indicated they might move away from negative rates to try to rein in inflation pressures, but almost certainly the pace of normalization for these two central banks is going to be slower compared to the Fed. It's also likely to be slower compared to some of its advanced economy peers. So we think that the shorts still offer sizable carry in comparison to still some modest overvaluation in these two currencies. So probably these positions would still be able to offer returns, not just from the compression or overvaluation, but also from the fact that you have a positive carry coming through. And with that, I will end my presentation, and we can look forward to taking questions from our audience, as well as discussing how the outlook is for currencies. I think Philip's on the line, so he might be able to give some views on that as well. So back to you, Eugene.
Yeah, thanks for the very interesting presentation, William. So it's quite an interesting tool because you can use that on its own without any kind of human intervention and get an unbiased view on whether an FX is over or undervalued. I'm wondering if we had a human overlay, would it be also quite interesting in these very, very volatile times where there could be regime shifts happening, or there could be some central banks who are very, very resistant to act as fundamentals dictate. Right, so I'll just offer up to our analysts. I believe Philip Timer is also on the line. Would any of you want to chip in, and then maybe Wei Liang wrap it up?
Hi, this is Philip here. Thanks, William, for a very interesting presentation. I couldn't help but notice that the components, are quite closely. It's a bit like the DXY basket, except that you have thrown in, I think, the Aussie, the Kiwi. So I think generally, I've always viewed the Australian dollar as some kind of Asian currency basket. So I guess that's some kind of proxy for the region. By and large, I think I'm just wondering whether it is possible to improve, let's say the returns of this model. Let's say by including more liquid, let's say Asian currencies like the Sing dollar. Would that help? Yeah.
Right. So that's an interesting observation. So by expanding the set of currencies, then potentially because to push up the efficient frontier of the portfolio, right? So more securities always better than less securities, because you can always choose to have a zero weighting on any additional security, right? So definitely an interesting suggestion, but we have not done heavy duty back testing, right? So this is going to require effort in terms of trying to incorporate various new currencies and trying to create a more sensible model which could account for some of the quirks of emerging markets. So for the case of Sing dollar, as you mentioned, we all know the MAS has a very strict control in terms of how the Sing dollar will trade based on the Sing band. So this is something that will require a little bit more delicate modeling before we would incorporate into any kind of strategy. But definitely the option of putting it into the strategies is definitely possible.
Thanks very much. The reason I'm asking is I have also noticed that you were talking about the basket comprising of good quality currencies. So I always considered Sing dollar one of them. Is one of few AAA, and we've seen also some central banks taking more interest in including the currency in their reserve basket.
Yeah, I mean, I will agree with you that Singapore is one of a very shrinking circle of AAA rated countries that we should definitely incorporate in the future. Most countries after COVID, they have seen their ratings coming under pressure. Singapore, for the record, is actually doing a lot better than most countries in Asia. So maybe I do have a question for Eugene, since we kind of talk a bit about how the dollar has softened because US Treasury yields have been easing somewhat in the last month or so. So does that mean there's a turning point in sight, or what do we think in terms of US Treasury outlook?
Yeah, I think we're at a pause moment, right? Because there's just too much fear by the early part of May, and certain indicators that we've been tracking indicate that perhaps peak fear for now has passed, and if peak fear for inflation and rates have been hit, then it would allow some kind of recovery across all asset classes, including FX and stocks, right? So I think some of this it has been playing out. But I think the issue here becomes one of time frame, right? So for now, things seem to be okay, but we haven't seen convincing signs yet that the inflation has come off from its boiling pace, right? So I think we need to see U.S. inflation slow to an annualized, say, 3% before we can see a clear downshift. And there isn't a lot of clarity on whether the U.S. economy will slow a lot more than expected, which is the two issues that we are grappling with. Either we go into a recession or we're heading into a regime shift where interest rates are going to be significantly higher than what we are used to over the past 12 years or so, right? So I think it is tricky. We have hit most likely an interim top, but the jury is still out for the longer term, meaning 3 or 4 months ahead.
Right. So where do we think neutral rates are for the US, or actually for the countries that we are looking at in the DBS strategy? Are there meaningful changes that we should be aware of?
I think these are elusive, right? The neutral rates change with each crisis, so it depends on the environment that we're heading into. So that is the elusive magic number that all policymakers are trying to put their hand on, right? And it requires two components to get a grasp of the neutral nominal rate. First, you got to figure out what inflation is going to be long term, and the second, what the neutral real rate should be, right? It could be between 0.5 or 1%, right? That is our best case. And if we assume inflation to be 2.5 to 3% long term, then we can get a nominal neutral, right? Nominal neutral of about 2.75, and if we need to go tight, we go to 3.5 as per our forecast. I would also note that Timer is with us. I'm not sure whether he would like to add a few more comments on FX or the global economy.
Hey, thank you very much, Eugene. Hi, everybody from Jakarta. I'm really pleased to see that this thing is actually working, and I hope the background noise is not too much of an interference. William, a great presentation. Before I'll have something to say on the neutral rate, but I also want to leave you with a question, which is volatility part. What's your sense of the DEAR indices volatility in the last couple of months relative to the previous periods that you have studied? So that's my question for you. And on the neutral rate, I just want to point out that Singapore hosted this Asian Monetary Policy Forum last week, and there were many people, Fed watchers, academics from the US and Singapore who commented on this precise question of, is there a time varying aspect to the neutral rate? And the answer is basically yes, that depending on the cycle, depending on the structure of the economy, what is considered neutral rate in the 80s and 90s is very different from now. In fact, the notion of neutral rate itself has changed over the last couple of years. So in the middle of the pandemic, it was believed in real terms to be in the negative territory, that you were in the zero lower bound situation where you had to take interest rates down to zero and do QE to get the economy anywhere close to something for support that it needs. Whereas now the view is it is in the 0 to 0.5% range, real terms, which means if in the forecasting horizon we're looking at 3 to 4% inflation, the terminal rate or neutral rate, if you will, has to be well over 3. Now, I'm sure you've just heard from Eugene, given the growth dynamic, the ability of the market and the economy to absorb that is questionable, but beyond that, it's okay. All right, it is 1 or 4 o'clock and there's a lot of background noise. So I'm going to shut up. William, that final question on the volatility of the year, if you may.
Right. So that's a very interesting question. So the volatility of returns, I would say, is probably a bit on the higher side compared to the historical experience, but not to the extent of being completely out of our bounds or expectations. So such volatility that we're seeing in the last 3 months have been a bit more elevated. I think that's partly understandable from a point of view that we have broad-based dollar strength. And when that happens, that generally creates a fair bit of currency moves that could be a little bit stretched, like what we're seeing happening in the Japanese yen. But of course, given the very long time period of backtesting that we have done from 2010 till now, there have also been pockets of time or periods of time where volatility was also quite significant. So our expectation is that this will eventually fade out. And if you think US Treasury yields has effectively stabilized at current levels. So remember, yields have moved up very sharply this year, right? So it was over 100 basis move at one point in time. So if US Treasury yields stabilize, then perhaps that will also encourage a bit of a stability in the currency markets, and necessarily that will mean that the deal returns will have a more, I would say, more prosaic kind of return profile.
Okay, thank you very much. It's 5:01. We've overran by 1 minute. So thank you everyone for joining this session. We hope you found it useful, and do join us for our subsequent webinars. Goodbye.
Thanks everyone. Bye-bye.